20 रुपए दोगे तो एक राज की बात बताऊंगा। हाँ।
Welcome to today's deep dive into one of the most powerful concepts in the market.
चलिए शुरू करते हैं।
Liquidity. Liquidity is the true engine behind price movement, and if you can master how it works, it can completely transform your trading game. Imagine being able to read the market like smart money does, aligning yourself with the big players like banks and institutions instead of falling victim to their traps. Most traders get caught on the wrong side, losing money in liquidity traps, while smart money collects their profit.
अरे कहना क्या चाहते हो?
But in this video, I'm going to take you beyond the basics. We're breaking down liquidity concepts step by step, from the fundamentals to advanced strategies. Avoid common mistakes and maximize your profits like a pro.
साले को बम से उड़ा दूंगा एक बार हाथ में आ जाए तो।
तू समझा? हाँ। नहीं, तू समझा नहीं।
So, what is liquidity? Liquidity refers to specific areas where large institutional players are likely to execute massive orders. These zones are filled with opposite market orders, such as stop losses and stop orders set to capture breakouts. Think about it. Around key levels like major highs, lows, trend lines, or areas with equal highs and lows, liquidity is waiting. The trick is that smart money often pushes the price toward these zones to grab that liquidity before the real market direction takes shape. This is why traders frequently fall into bull or bear traps.
अबे जल्दी बोल, कल सुबह पनवेल निकलना है।
Buy side liquidity and sell side liquidity. Mastering these liquidity zones won't just help you avoid getting caught in traps set by market makers. More importantly, it will allow you to follow their footprints and turn their tactics to your advantage. Let's start with buy-side liquidity. This is an essential concept that's key to understanding how market makers operate. So what exactly is buy-side liquidity? Simply put, it's the volume of pending buy orders, also known as buy stops. These orders are often placed above key highs, whether that's the week's high, the day's high, or equal highs. Here's how it works. When traders execute sell orders, they protect those positions with buy stops in case the price moves against them. These buy stops rest above those significant highs, and smart money knows it. Market makers target these highs, sweeping them to trigger those buy stops. Once they do, they convert those pending orders into market orders and then drive the price in the opposite direction. This process is known as a liquidity hunt, a tactic designed to trap retail traders. Look at this chart example. As you can see, the market formed equal highs, known as buy-side liquidity. Market makers swept the old highs, cleared the buy-side liquidity, and moved the market down, perfectly illustrating a buy-side liquidity hunt. Now, let's move to sell-side liquidity, which works in a similar but opposite way. Sell-side liquidity refers to the accumulation of pending sell orders, particularly sell stop orders, placed below key levels like weekly lows, daily lows, or significant historical lows. When traders place buy orders, they often protect their position with sell stops to mitigate potential losses if the price moves downward. These sell stops rest below those major lows. And just like with buy-side liquidity, market makers will target those lows, triggering the sell stop orders and converting them into market orders. Once they've captured that liquidity, they manipulate the market in the opposite direction, again profiting from retail traders. In essence, sell-side liquidity highlights how market makers exploit the relationship between pending sell orders and market direction. Look at this chart example. You can see the price broke through established lows, sweeping sell-side liquidity. Once the sell stops were cleared, the price reversed direction and moved up, demonstrating how market makers capitalize on sell-side liquidity. Now that you understand buy-side and sell-side liquidity, let's take a closer look at how market makers target these liquidity zones. They typically use two main tactics, the liquidity sweep and the liquidity run. Knowing how these tactics work will give you the insight you need to follow in their footsteps and capitalize on the same strategy smart money uses to dominate the markets. Let's start with the liquidity sweep. A liquidity sweep happens when the price makes a sudden move to grab liquidity before reversing in the opposite direction. For example, the price might push up towards equal highs targeting buy-side liquidity and momentarily break above those highs, but instead of continuing higher, it quickly reverses, trapping traders who entered long positions. Even if the price closes above the highs, it may reverse just as quickly with a wave of strong selling momentum. This is called a liquidity sweep because the primary purpose of this price movement is to capture liquidity, trapping retail traders in the process. Once the liquidity is taken, the price reverses, and smart money profits profits from the chaos. Now, let's look at the liquidity run. A liquidity run is when the price moves in the direction of the prevailing trend, targets liquidity, and keeps going without reversing. For example, in a bullish market, the price might target a previous high, sweep the buy-side liquidity, sitting above it, and continue rising to make a new high. By understanding these two tactics, liquidity sweeps and liquidity runs, you'll not only avoid getting trapped by false breakouts or breakdowns, but also be able to position yourself alongside smart money and ride the trend for maximum gains. But as traders, our goal is to follow the footprints of market makers, and the liquidity sweep is one of the clearest footprints they leave behind. Now, let's look at a real chart example of a liquidity sweep in a downtrend and how you can trade it effectively. Let's break it down step by step. Let's start by identifying the key liquidity zones. In this downtrend, price has been steadily moving lower, creating sell-side liquidity below previous lows. These areas are where retail traders have placed their stop losses for long positions, hoping the market will hold those levels. But smart money has other plans. Now, as the market approaches one of these key lows, it suddenly makes a move down, breaking through the previous low. This is where retail traders get stopped out as their stop loss orders are triggered, thinking the market is going to reverse. However, this move is actually a liquidity sweep, a tactic used by market makers to grab liquidity and reverse the price. After the sweep, smart money will have collected the liquidity they were after, and they're ready to reverse the price direction. Now, on the chart, we see that the market closed above the previous low, confirming the liquidity sweep. This candle that closed above the previous low is our signal that the reversal is about to begin. Once we've confirmed the reversal with the candle closing above the previous low, we're ready to place our trade. In this example, the sell side liquidity was taken, and now we're looking to enter a long position as the price starts reversing upward. Your entry should be placed right after the candle closes above the previous low to catch the reversal early. For risk management, we place our stop loss just below the liquidity zone, in this case, just below the previous low that was swept. This keeps our risk tight, while giving the trade enough room to breathe as the price reverses upward. For take profit, we aim for the next key resistance level, ensuring a 2-to-1 risk to reward ratio to maximize our gains while keeping risk under control. The same approach applies in an uptrend, but in reverse. You'll be looking for a liquidity sweep above a previous high, and then enter a short position after confirmation. Now that you understand what liquidity is and how it works, let me share with you 3 powerful liquidity patterns used by market makers. These patterns will help you spot where smart money is operating and how you can take advantage of these opportunities in your trading. Let's start with one of the most common liquidity patterns, equal highs and equal lows. Equal highs occur when the price reaches the same peak twice without breaking through, forming what retail traders see as a strong resistance level. This creates a horizontal line that traders interpret as a clear signal to place sell orders just below these highs, with stop losses placed right above, expecting the price to fall after retesting this resistance. Now let's take a moment to dive into the psychology behind equal highs. Why do these levels get so much attention, and how do market makers use them to their advantage? Let's break it down. Market makers and institutions know that retail traders place stop losses just above equal highs, viewing them as strong resistance levels. Smart money sees these levels as pools of liquidity and pushes the price slightly above them to trigger those stops, capturing the liquidity.
Hey, I've seen this one. This is a classic.
Driving the price above these equal highs, market makers trigger stop losses, causing a liquidity sweep. After gathering this liquidity, they reverse the price, leaving retail traders trapped in losing trades and profiting from the false breakout. Now that we understand the psychology behind equal highs, let's move on to something even more practical: how to spot and trade equal highs liquidity patterns. This is where the real opportunity lies, so let's break it down step by step. Look for horizontal resistance where the price has tested the same high level twice or more without breaking through. This signals that many traders are seeing this as a strong resistance zone. When the price starts to break above these equal highs, don't rush in. Wait for confirmation of a false breakout. If the price moves above the highs, closes above it, but then suddenly reverses and closes back below the equal highs, you can anticipate a liquidity sweep. As you can see here, this is a clear buy-side liquidity sweep. Sellers who placed their stop losses above the highs got triggered, and beginner traders, thinking it was a breakout, jumped in only to be caught off guard when the market closed below the equal highs, hitting their stop losses as well. This is a common market maker trap that happens frequently in the market. Once the price reverses and closes below the equal highs, You can enter a short trade after the false breakout. Place your entry at the candle that closed below the equal highs, with your stop loss just above the liquidity zone. Your target should be the next logical support level, aiming for at least a 2-to-1 reward to risk ratio. Equal lows form when the price reaches the same low twice, creating a perceived support level. Retail traders often view this as a safe area to place buy orders, expecting the price to hold at support and bounce back up. They typically place stop losses just below the lows, anticipating that the support will protect their trade. Smart money recognizes that retail traders place stop losses just below equal lows, expecting the support to hold. Market makers use this as an opportunity to trigger those stop losses by briefly pushing the price below the lows, creating a fake breakdown before reversing the market upward. Now let's dive into how you can spot and trade these equal low liquidity patterns. Look for horizontal support where the price has tested the same low level twice or more, forming a zone where retail traders are likely to place their buy orders. Watch for the break and reversal. As the price drops below the equal lows, don't immediately go short. Watch for a liquidity sweep, where the price briefly breaks the lows but fails to close below them. When the price reverses and closes above the equal lows, it indicates that smart money is sweeping liquidity and preparing for a reversal. Once the price reverses, you can enter a long trade after the false breakdown, placing your stop loss just below the liquidity zone. Your target should be the next logical resistance level,